Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, hello and welcome to today's lesson. Today we are looking at financial elements. We'll start with assets.
An asset is a resource with an economic value. Individuals, corporations, and countries expect the assets they own to provide economic benefits now and in the future. Assets can be tangible, such as equipment and land, or intangible, including things like a brand, a chemical formula, or property rights. Assets are vital to a firm's success because they increase its value and provide the means to generate cash flow. They're important to an individual because assets, such as a bank account, a home, or a car, are necessary to satisfy daily needs. And assets are of great interest to investors who want to know what a firm owns and what it owes. Companies list assets they own on their balance sheets. A firm's total assets will equal its liabilities plus equity. Current assets are those that will be consumed within a year, including items such as cash, accounts receivable, and inventory. Fixed assets, including equipment and buildings, are expected to provide benefits beyond a year.
Okay, assets. The definition: an asset is something of value owned by the business. Now these are resources which are controlled by the entity as a result of something that's happened in the past, usually some sort of transaction, and specifically an entity from which future economic benefits are expected to flow to the entity being the business. So for example, Burton's Bakeries purchased a new oven. Purchase past tense, so it's a past transaction, and the oven is used to make pies. The pies will be sold for a profit, which is the economic benefit. So asset, something of value owned by the business as a result of a past event which will bring future economic benefit. Easy examples here: cash in the bank, motor vehicles that a business owns, equipment that a business owns and uses to manufacture their product, the stock, inventory or goods, accounts receivable or debtors, and these are people which will owe the business money from previous purchases. Liabilities, almost the opposite of assets.
A liability is an obligation that arises during the course of business. It represents a third party's claim on the company's assets, usually from lenders or other creditors. A liability can arise in a number of different ways. Liabilities can be a type of borrowing or a promise to pay later. Examples of this are accounts payable, trade payables, and unearned revenue. A liability can also arise from an agreed-upon obligation to borrow funds to be paid back at a later date. Examples include long-term bank loans and the issuance of corporate bonds. Finally, a liability can arise due to a legal obligation, usually the result of a law or statute that requires the company to pay money to the government or other third parties. Examples of this include sales tax payable and accrued but unused employee vacation pay. Liabilities are an indication of future use of company funds, since liabilities have to be paid eventually. In fact, on most formats of the balance sheet, liabilities are grouped as current, short-term, and non-current, long-term, to give an indication of when they must be paid. Current liabilities are usually due within 1 year or less, while non-current are those due in more than 1 year. Analysts use liabilities as part of the accounting equation. Assets minus liabilities equal owner's equity. This gives investors important information for analyzing the liquidity and solvency of a firm, including the ability to repay loans, interest, and long-term debt.
Looking at liabilities in a little bit more depth here. Our definition, a liability is an amount owed by the business. Now these are present obligations of the entity, of the business, that arise because of past events. Again, usually transactions, just with assets here. Past events which are expected to result in an outflow of resources representing economic benefits when settled in the future. So for example, Burton's Bakery used electricity in the last month, so that was a past transaction. The electricity costs money each month, and that electricity is used to run ovens, etc., so that the pies, cakes, breads, donuts, etc. can be baked and sold for a profit, which is the economic benefit. A business is not going to take on a liability if there is not some sort of a benefit that will flow from that liability that's been taken on. Classic examples: bank overdrafts, loan, mortgage, and accounts payable, or sometimes termed creditors. Accounts payable, creditors. These are people, entities, other businesses that the business will owe money to, usually from past transactions, previous purchases the business has made. Equity.
A balance sheet is a statement of net worth. It's broken up into three sections: assets, liabilities, and equity. A equals L plus E. Meet Joe. Joe goes to the bank and gets a small business loan. The bank gives him cash. On the balance sheet, his liabilities increase by the size of the loan, and his assets increase by the same amount. The balance sheet remains in balance. Joe uses the cash to buy a truck and start his own pizza delivery service. His cash assets decrease, but that's balanced by an increase in his other assets, a new truck. As Joe delivers pizza, the profits are recorded in the balance sheet as retained earnings in the equity section of the balance sheet. The cash from his profit is recorded in the assets section, balancing out. Every month, Joe makes a payment against his loan. He reduces his liabilities by the amount of the payment, and his cash is reduced by the same amount. To find out his business's worth, Joe subtracts liabilities from his assets. This equals the net worth of his business.
Okay, equity. Equity is the amount invested by the owner in the business. So equity is what is left over, residual interest in the assets of the business after subtracting the business's liabilities. So assets minus liabilities is going to give us equity. So equity is the amount of assets that the owner has invested in the business. It's the owner's investment in the business, and equity is also called capital. So $107,000 what you own, $28,000 what you owe. So the business owns $107,000 worth of assets. $28,000 is a liability the business owes us, and the difference is going to be the equity, what belongs to the business, what belongs to you, the sole trader. So assets, $107,000 minus liabilities, $1,000 will give you the owner's equity, $79,000. Assets, what you own, liabilities, what the business owes. The difference between the two gives us the business's equity, the owner's equity. And this brings us to our all-important accounting equation. Equity, what the business is worth, is equal to the assets of the business minus the liabilities, what the business owes. Equity equals assets minus liabilities. Don't forget this ever. Right, you quickly, I would like you to write these down. Asset, liability or equity. So cash at the bank, is it an asset, is it a liability, or is it equity? Cash at the bank, building. Inventories, this is stock that the business will have on hand. Either products that they have on their shelves which they haven't sold, or in their warehouses which they haven't sold, or component parts used to manufacture the product that they're making. machinery, bank overdraft, accounts receivable, vehicles, accounts payable, capital and furniture. Cash at the bank, asset, liability or equity, asset. Building must be asset. Inventories, asset. Machinery, asset. Bank overdraft, here we come to the first liability. Accounts receivable, asset. Accounts receivable, these are creditors, people or businesses that owe the business money. Vehicles must be an asset. Accounts payable, almost the opposite of accounts receivable. Liability, this is money that the business must pay to settle an electricity bill or purchase of raw material or component parts, etc, etc, etc. It's money that the business has to pay. Capital is our other term for equity, so capital must be equity, and furniture is easily identified as another asset. Okay. Your task, your homework, part of your homework after the completion of these notes is to make a list of assets and liabilities that a restaurant may have and bring this list to class tomorrow. Okay.